What if a company had its most profitable month ever, but had zero cash to show for it? It's a common business problem that highlights the difference between counting cash and measuring true performance. The solution is a concept called accrual accounting. By the end of this video, you'll understand how it works and why it's the gold standard for any lasting business. Section 1. The problem, the easy street of cash accounting. First, the simple way, cash basis accounting. You record money when it hits your bank and expenses when money leaves. It's intuitive. A client pays you a $1,000 deposit in February. That's February income. You buy $300 software in March. That's a March expense. Your bank balance is your report card. But as a business grows, this simple method starts painting a dangerously misleading picture. Section 2. The conflict, where cash accounting falls apart. Let's see where cash accounting lies. Imagine your company, Apex Innovations, lands a $100,000 order in December. You deliver everything by Dec 28th and send the invoice. But payment terms mean you won't get paid until January. Using cash accounting, how much revenue did you make in December? 0. In fact, your December report looks like a disaster, showing sky-high expenses and no income. Your profit is deep in the red. Then, in January, the $100,000 cash arrives. Suddenly, January looks incredibly profitable, even though all the work happened in December. This mismatch makes it impossible to plan or see the reality of your business. Section 3. The solution, how accrual accounting tells the truth. This is the exact problem accrual accounting solves. The core idea is powerful. You record transactions when the activity happens, not when cash moves. Revenue is recorded when it's earned, meaning you've delivered the product or service. It doesn't matter when the customer pays. Likewise, an expense is incurred the moment you receive a good or service, not when you pay the bill. This method provides an honest movie of your company's performance, which is why it's the required standard for serious businesses under rules like GAAP. Section 4. The climax, our story retold the right way. Let's replay the Apex story with accrual accounting. It's December. You deliver the $100,000 order. The moment it's delivered, you've earned the revenue, so you immediately record $100,000 in revenue for December. The cash you're waiting for is recorded in an account called Accounts Receivable. Think of it as a folder of official IOUs. It's an asset representing money legally owed to you. Now, your December income statement shows $100,000 in revenue, a true reflection of a record-breaking month. In January, the client pays. Your cash account goes up by $100,000, and your accounts receivable goes down by the same amount. It's just cash moving from one asset pocket to another. No new revenue is recorded in January because it was already earned and recorded back in December. Section 5. The why, the magic of the matching principle. This is powered by the matching principle, which says you must record expenses in the same period as the revenue they helped generate. Let's say you owe a $5,000 sales commission for that December deal, but you don't pay it until January. The cash method would wrongly put that expense in January. The matching principle asks, what sale did this expense help create? The December one. Therefore, that $5,000 expense belongs on December's books, matched against the $100,000 revenue. This connects the cost directly to the sale, giving you the truest picture of profitability. The bottom line is this: cash accounting is simple. but it gives you a chaotic, misleading view of your business. Accrual accounting, by recording revenue when earned and matching expenses to that revenue, tells the true story of how your company is performing. It's the difference between counting cash and truly understanding your business. If this video helped the accrual concept finally click, hit that like button and subscribe for more simple breakdowns of complex topics. Thanks for watching.